Good afternoon, everyone. I'm Steve Seepersod coming to you from the campus of Binghamton University. So excited to start the new season of alumni webinars. As always, here on campus, it was a fast summer and now we're into fall. So we started out with that very cool looking picture of the clock tower in fall foliage. It doesn't quite look like that yet here in Binghamton, but it will soon. But this is a great opportunity for me to put a plug in for homecoming weekend, which will be starting 3 weeks from Friday. So September 27th to the 29th. Join us here on campus. Is going to be a homecoming celebration. We'll have our traditional homecoming favorite events and celebrate the success of the Accelerate campaign for Binghamton University. So come on out and join us. I'll put our website address up here on the screen. You can get to the homecoming website from binghamton.edu/alumni, binghamton.edu/alumni. Sign up for homecoming, still plenty of time. You can check out the schedule online, see all the great stuff that we have coming up during the weekend. You will want to be here. Trust me, it's going to be a great, great weekend. Also, while you're on the alumni website, and do all this after the webinar, don't do it right now, although I know you're capable of multitasking, but after the webinar, check out the many things that we have to offer you in addition to what will be a wonderful homecoming weekend, many lifelong learning opportunities in addition to this webinar series. Our Tier Talk speaker series, we'll have that at homecoming. We have an alumni travel program. We have an alumni book club, events on and off campus, all sorts of ways you can be involved with us. Binghamton.edu/alumni is the place to go to see all of that. Again, after the shows, I'll pull this back and we'll move on to talking about the webinar for today. So a little bit of housekeeping. We want to take your questions and have this program be as interactive as possible. It's always more fun when you get involved. So start now with sending in questions. If you're watching on Facebook or the microsite, send it in as a comment in the comment box, send your question as a comment, or I'll put up my email address from time to time on the screen. I'll be checking my email. So any one of those ways to get a question to us, and we will get these mixed in. Although we will have time for questions at the end of the presentation, certainly we'll make time during and fit these in as best as possible. So start now if you'd like. And so this is a topic that I know is of high interest, that a lot of people signed up for the webinar today, and long-term care insurance and planning for the future, and trying to put yourself and your family in a good position is something that's front of mind, I know, for a lot of people. So with that in mind, enough of me. We'll bring in our featured speakers for today. So the first one I'll bring in here on the screen, and we actually have two, is Everson Davis from the class of 2019. Is quite an interesting background. Played basketball when he was here at Binghamton, so it's always great to get former athletes into the mix. Working for New York Life in New Jersey, and is an expert on the topic at hand today. And we'll bring in Terry Judge, and Everson will tell us a little bit more about his colleague, Terry. Hi, Terry. And I'll turn it over to them for what will certainly be a stimulating presentation. And again, if you have questions, certainly feel free to get those in whenever you would like. So Everson and Terry, thank you so much for joining us. And we're really very appreciative to have you here with us today.
Happy to be here. Thank you.
Thank you, Steve. Thanks for having us. Thank you. Well, it's such a remarkable, so remarkable to consider that Steve and I, we talked about this back in March, and it's September now, right? And when we first brought this up, Steve, he put on LinkedIn that, hey, we're doing seminars and webinars for Binghamton alumni, and he has some topics here. Is anyone interested? I saw the healthcare topic, and I reached out to Steve, just like, hey, I just came across this interesting thing about long-term care and this tax that was imposed in the state of Washington. And I just think it was something important that everyone should know about, because usually when one state does something that, everyone starts to follow suit. So, Steve and I, we got on Zoom, we talked a little bit, and he agreed that this is something that, everyone should know about. And so we're here today. With me is Terry Judge. I try to do a more team approach when I'm running my business, running my practice. It could be from, my sports background, but when I do webinars and seminars, I like to have my product consultant with me. Terry's been with New York Life for 5 years now, Terry?
7 now, actually.
7. Sorry, 7 years. So she has a lot of experience in that long-term care field. We're gonna have some fun today. We're gonna talk about long-term care and the benefits of it, and how important it is, to have that inside of your, retirement planning. So before I even go into that, I just want to introduce myself a little bit. For those who don't know me, my name is Everson Davis. I'm a registered rep with New York Life. Just a little bit about me. I was born in the island of St. Kitts. It's in the Caribbean. Before I moved to New Jersey for my freshman year of high school, I went to another island in the Virgin Islands, St. Croix, where I lived there for about 4 to 5 years. Then I made my transition here to the United States. That's when I got to the United States. That's what kind of found my love for basketball. It was able to take me places I wouldn't be able to go without it. I graduated from one of the prestigious high school in Hightstown, New Jersey. It's called Petty School. From there, I went on to Binghamton, where I was a student athlete here at Binghamton for 4 years. Great 4 years. I wish we could have won some more games, but it was still a good time. When traded for the world, I was able to meet a lot of my close friends, close brotherhood, and I'm so happy. I'm fortunate to be in this position where I could kick off the new season and, just give back to the Binghamton community, because they took care of me when I was there, and I'm so proud to be a Bing alum. After college, I kind of want to pursue basketball professionally. What ended up happening, I was, get ready to go over to Spain, and what happened, my body just couldn't take anymore. And in college, I had 2 surgeries, my freshman year, 1 in junior year. So my body was kind of giving up on me. So, I kind of went to the work field. That's where I started a business with my mom and I. She's a home health aide. And what that is, we're actually going to talk about that a little bit. She took care of elderly people, disabled people, anyone that needed assistance with assisted daily living needs, and what we call ADLs, which we're going to talk about that as well. Terry will dive into that. But it's so how I got into New York Life. COVID kind of happened, and I feel like a lot of people, businesses kind of suffered a little bit. So I needed something to supplement what I was doing, and that's how New York Life kind of found me. I'm kind of in the aspect that things happen for a reason, and me finding New York Life just needed to supplement what I was doing, and now it turned into a career. It's unbelievable, and now I'm such a big advocate for long-term care because I was a business owner in that field, and I've seen what it can do to retirement assets when someone is not prepared. For example, like giving this story a lot, I had one client, her mom was on hospice. And for those who don't know, hospice is when, maybe that individual has a terminal illness and the doctor gives that individual maybe 6 months or less to live. And this one client, the doctor gave her mom 2 months to live, and she ended up living 2 years. Now, it's great. It was great that, she got some more time to spend with her mom, but what ended up happening, she was not prepared financially. And what happened, I had to extend a lot of grace to her at times, but I've seen now the importance of having that long-term care inside your retirement planning. And I'm such a big advocate for that. But, I'm not want to take up too much time. I know we have a little 15 minutes or so to talk about this. So Terry, if you want to introduce yourself and kick it off, go ahead. And as Steve mentioned, please feel free, hop in that question box. If you have something, drop it in there. I know Steve want to keep this interactive, and so do we. So go ahead and email your questions you see at the bottom there. And if you have any questions, please let us know. But Terry, go ahead.
Thank you so much for having me here today. I'm very grateful for everyone out there listening, because it is a topic that I feel very passionate about. I've been with New York Life now for 7 years, but I was an engineer before, and when I switched careers to actually helping people instead of producing more widgets, I'll call them, I really became enamored with the fact that very few people understand even what extended care or long-term care is. So I'm very happy to be here and spend some time with you today to go through it. And so with that, I'll get started just by saying that this presentation is all about having more choices, having more options when it comes to a potential future long-term care event, which also gives you more control over a situation that you don't always have a lot of control over when you wait for the situation to happen. So it's going to be really about taking some notes, kind of workshop style, question and answer, always welcome, to develop an informed and lasting long-term care protection strategy today. And usually the slides themselves don't take more than, I would say 15, maybe 20 minutes. But it's more about you getting information that you need. And of course, Everson will be that resource for after this is over today. So thank you again for being here. Sometimes I like to just start by not, what is long-term care, but maybe what long-term care is not, right? It's not medical care intended to get you better right away. Otherwise, health insurance would cover it and it would be more medically related. But really, it's those everyday services and supports that you might need when you can't do your independent everyday living activities, like the 6 activities listed on the screen, right? There's transferring, getting in and out of bed, feeding yourself, bathing yourself, dressing, even doing the buttons in the back of your blouse. And then there's toileting and continence. One's more about control of bodily functions, and one's the safety of getting to and from a restroom, on and off a toilet, hygiene associated. So what they say is that, how do you define a long-term care event, right? It's when you need help with 2 out of 6 of these ADLs, those activities of daily living that Everson already mentioned. Or, and this is a big or if you have cognitive declines, you need help to safely do those activities. That's what a long-term care, sometimes called extended care event is. And it's expected to last at least 90 days. So why would we want to create a long-term care strategy then? So basically, it's about taking more control over the different locations where your care might take place. So we want to pay attention to maybe even ranking that when we go through the different locations. Many people, especially post-pandemic, want to maximize time at home if they need care, staying in the comfort of their own home. Maybe it's more accessible to family, friends, and neighbors to be around. And at the end of the day, we really want to think about protecting family and protecting our hard-earned retirement dollars also. And all of this should and potentially could lead to added peace of mind. So a lot of people will ask me, what creates the need for long-term care? Is it always like, old people in nursing homes? Well, not always. Sometimes it is that normal part of life where we simply become older and more frail, but sometimes it's part of treatment for an illness, an accident, an injury. If we think of things that happen like to Michael J. Fox getting Parkinson's at way too young of an age, or Christopher Reeve, Superman falling off a horse, right? Sometimes things in life can happen. And it can be an illness that's either chronic or we get better from, or maybe an injury that is kind of chronic or we get better from. But also we have to pay attention to how often does this actually happen? And this is from the U.S. Department of Health and Human Services, that most of us eventually, once we reach that retirement-ish age, right, are expected to need some type of long-term care in our remaining years. So when you think about today's presentation and you think about how to organize your thoughts, you might want to take a piece of paper and a pen and just draw 4 boxes. And we're pretty much going to go in order, kind of clockwise, right? From who to where to how to solution. So who would that person who would get that phone call be when you actually need care? Where do you prefer to receive it? Where are those 4 locations? We're going to go over those. How much does care cost at those different locations? And what's the best funding solution or the best solution in general to be part of your strategy? So we think about who would be our who person. Sometimes I sound like an owl when I say that, but we want to think about, what does that family caregiver look like? They do say that 1 in 5 Americans right now are caregiving to either, a special needs child or a parent and in-law that actually needs care, long-term care. So the average age of that person's around 49 years old. And that tends to be at a time in life when time is valuable. And if you look at the average number of hours, to me, that almost strikes me as having a part-time job, right? Whether that's on top of having a full-time job and having repercussions at work, or maybe it's on top of being what's called part of the sandwich generation, which sometimes this aged person might have young ones still at home, but also have expectations, and they have that love and that family bond. They want to help their aging family members as well. So that's what we want to think about. We just want to shine light on how special it is to be able to do that family caregiving, but also see what other options we might have to have some respite for that situation as well. So long-term care can take place in all 4 of these different locations. We already mentioned at home, where a lot of people prefer that. In your community, in the form of adult daycare centers, which are becoming more popular because you can be social and get your meals and go there during the day. Assisted livings are more like apartment-like settings, and nursing homes are more like hospital-like settings. So if I were to ask you all, and maybe you can write in the Q&A if you want to just kind of do a poll, where do you think most people do receive care? It's actually 90%, which is a big percentage of those receiving long-term care today are receiving that at home or in that community setting and not in a nursing home. So now that we understand the different locations, we might want to explore how much does long-term care cost? So basically, no, we don't have a crystal ball, unfortunately, to do this type of planning, but we do have different care scenarios, I call them. We do have knowledge that the average woman might need care for 3.7 years, the average male for 2.2 years. So what we did here is just taken an example of needing 1 year at home, followed by 1 year assisted living, followed by 1 year in a nursing home, for a 3-year extended care event or long-term care event in different cities across New York. So if you are to look at the average cost of home health care, which we already said is 90% of the time where care is taking place, we can see that the average is about $65,000 a year, followed by, those costs can vary very widely across the assisted living and the nursing homes because real estate costs are involved. But at the bottom of there, when it says the total cost over 3 years, just kind of maybe jotting down that information, or you might be like, well, we want to retire in Florida. We want to look at costs elsewhere. So it might not be over 200,000 or 300,000. If you go to our cost of care tool, I would encourage you to maybe take a picture of the QR code, and then you can actually go and play in the tool just to put in different regions and what those different care cost scenarios might look like for your specific situation. So it does happen to have some really good information on there. So I'll kind of point again to the home health care aid. That's not 24/7 care. A lot of times this care need is progressive. And on average, that's about 40 hours a week is what would comprise that $65,000 annual cost. So now that we have a little better understanding of how we would pay for, or how much care can cost, how would we pay for care, right? We start to think about and project, like, what do we expect for guaranteed income in retirement? Where are our assets located, and which assets would we actually use to pay for care? And a lot of people might say, well, I'm a business owner, I'll sell my business, or I have real estate, I'm going to sell some real estate. We want to think about any tax and liquidity consequences, if those are what's being set aside to think about care as well. So what is your ideal long-term care solution? So before we kind of dig into that, in general, there's 3 different ways to fund your long-term care costs. There's government programs, and we're going to break down how Medicare and Medicaid work at a very basic level. We're going to talk about paying out of pocket for care, right? Out of our savings, our investments, our income. And also, what does it look like to have an insurance blend or, a mix of out of pocket expenditure with insurance? So those are 3 things that we'll go into in a very little detail before we move on to what solutions we have available to you. So Medicare is our health insurance when we worked enough hours in the US. And again, health insurance is meant to get you better right away. So therefore, it goes to reason that Medicare really does not cover long-term care. But there's a really good reason why a lot of Americans think it does. And that's because if you were to be hospitalized for at least 3 full nights and then discharged to a skilled rehab center, they will pick up the first 20 days in full. Then they'll pick up partial costs for days 21 through 100, anything over whatever the current year's copay is. I think it's up to $209 a day right now. But they really don't cover those ADLs. Those ADLs, you need custodial care, not medical care. So that's why after 100 days, you really can't rely on Medicare for long-term care. Medicaid, however, is a program that was set up to pay for long-term care, right? And actually, Everson mentioned this too, and Medicaid is part of a state budget, right? It's state and federal funded, but it does pick up the majority of costs for long-term care, but not right away. It's after people have to spend down their own assets first and their own income first, right? Everything above a certain threshold, state by state, needs to be spent on care. Vary state by state. It's very involved. So I encourage you to maybe go to the website. There's Medicaid planning attorneys to learn more. But there's also things to know, like you may have limited choices of care, and the program tomorrow may not look like what the program looks like today. So we just want to keep in mind that the premise of this presentation was to give you more choices and control over care, and you're not necessarily going to get that with Medicaid. It's a great program for those who need it, right? Meant to be a welfare program, but it's good to have information about that as well. So that option 2 for funding long-term care was to pay for care out of pocket. This happens to be what happens most of the time, because people don't really understand that there's things they can do ahead of time to kind of get ahead of the risk, right? But if they do come upon retirement and then there's, a certain fixed income for the household, what if you're still in a marriage or still have a family around? There's going to be an impact on lifestyle. When all of a sudden, if you think back to the $65,000 annual home care number, that's also coming out of income. So then people will say, well, I've saved a lot in my 401k, my 403b, right? That's considered a qualified personal asset, meaning we haven't yet paid the taxes on it. So if we were to go pay $1 for $1 of care, we might have to pull out $1.20, $1.30, depending on our tax bracket, to actually pay for that. So that's what we call a tax consequence. And we want to keep that in mind, because we already looked at that total cost of care for 3 years example of being over $200,000 or over $300,000 in today's dollars, never mind what it could cost in the future. And then there's savings, right? Some people might use their savings, and we're all encouraged to have 6 months of liquid savings there, but there's not really going to be any leverage on those dollars if used. Which brings me to, what types of long-term care coverage does New York Life have to offer? So this would be starting to talk about how could we mix in some protection from an insurance company to blend in with some of our out-of-pocket savings and income that we might have available to put towards some care costs. So we basically, when it comes down to it, have 2 different types of solutions. On the left in blue, we call it traditional long-term care insurance. I always kind of say think of it kind of like your homeowners or your car insurance. You pay for it over your lifetime or until you need the care. And it's all about the consequences of needing that care. If you think back to what the risk level is after we're 65 being 70%, it's a risk that a lot of people like to address in this way. Now, it does pay a dividend. Dividends can help you to reduce premiums over time, or if you're on claim as a benefit increase, the dividend will help you that way. But we can also think of it as an income-based solution, because we are stretching those premiums over a lifetime. It tends to be, it's meant to be very comfortable to come out of your income-based, whatever your income is coming into the household, so it fits a budget, for the most part, it's meant to do that. But then we have not a newer type of protection, I'll say. On the right, it's called a hybrid, or a combination of life and long-term care insurance. And you're going to think it sounds strange, but it's probably you're going to remember it this way. We call it live, die, or quit. If we live, we have the long-term care pool of tax-free money available for care. If we never need care, there's a death benefit to our beneficiaries. And there is also return of premium option. So if we ever needed to walk away and have cash, back from our policies, there's like an 80% return of premium, or even 100%. So we call this more of an asset-based solution, because we're repositioning assets to cover ourselves in 3 different ways of value, right? The long-term care, the life insurance, or the return of premium. But all the solutions that I mentioned, right? We have 2 traditional solutions and 1 hybrid. They all do the same thing. They would reimburse you for home care costs, facility care costs. They come with a care planning service, or I call it the care concierge team, which I'll go into a little bit deeper on another slide. There's in-home support equipment dollars. Right away you'd be able to access some of your benefits from your policy to put bathtub bars or ramps and things to help you stay home more comfortably. And then really important, because people are doing this planning at all different ages, and the younger we are, the more we have to consider what is the care cost going to be in the future. So our benefit has to be able to increase with inflation protection options as well. So a lot of this has to do, we said, with having more choices about where can our care take place. Maybe we have loved ones that want to help, but they work full time. They can't be there all the time. So we might have to hire a home health aide who's a professional and use our benefits for that. Some of our policies also allow for some informal care dollars to come from our benefits to provide kind of payback for our family and friends that want to help us. So you can receive care in the comfort of your own home with any of our solutions. Now, I mentioned the Advantage Care team, but I don't like to underestimate them. We have testimonials that say how helpful it is to have, a team that has a social worker, a registered nurse, a care planner to help you and the family navigate what is probably going to be a stressful situation no matter how you cut it, but they're going to help it, hopefully become less stressful. They'll remind you about all the bells and whistles in your policy and be that primary contact to help you develop that customized plan of care that's going to make the most sense. So things to keep in mind with insurance though, right? You might be like, well, why doesn't everyone kind of shift the risk in this way? Well, you have to be approved for it. You have to get underwritten, which is kind of like health checked. And because we don't generally get healthier as we get older, right, we want to make sure that if we think this could be part of our strategy, we don't usually want to wait too long, because it does become more difficult to get approved as we get older, just because different prescriptions we end up having, different conditions we have. And all of this is only looked at the time when you actually lock in the policy. And the premiums are based on, these 3 things we can't control: our age, our gender, and our health. Yes, as lucky females, we live longer, so we actually are riskier for long-term care needs. So if you look at what does the underwriting process entail, we do collect physician information last 5 years, current and past medical conditions, and then what are you on for medications and what are those medications treating. And we try to do a really good job in what's called a pre-screen and maybe collecting this information ahead of time if you're willing, so we can ask the underwriters like what to expect when it comes to showing you an appropriate solution. So with that being said about the different solutions that we have, what are your thoughts right now? Jot down some notes. What's the best strategy for you? Do you want to look more into Medicaid and go to some of the government websites or consult a lawyer? Do you want to self-fund your care and simply set the funds aside and you're okay with the consequences of what that is? Will you rely fully on family, or do you want it to be a blend of family and at-home care? The long-term care coverages that we mentioned from New York Life, we have the traditional and we have the hybrid. Did that appeal to you at all? Some of the different features that I mentioned in there. So
I'm sorry, if we could just take a pause right here. I know you had thrown a question out that you wanted the group to think about. I had a couple of others as well. And it could be for Everson or maybe for Terry or for both. And so on 1 or 2 of the previous slides, we had seen that this has to be underwritten. And so the person has to be in reasonably good enough health to be able to get this policy. So I'm curious from your side, and maybe this is coming up on a later slide, I don't know. What are the barriers preventing people from doing this? Because it just seems to make good sense to prepare and to make sure you're set up well and you get this type of coverage. It can be, there's some cost considerations, but from your experience, what are the things that you've seen that often prevent people from going ahead and taking this step?
Yeah, so barriers to entry, I guess I'll call them first, is that, there is a list of, there's a lot of conditions out there that make it more likely that you're going to need long-term care sooner rather than later, like knowing that 70% of us might need it. So the health consideration is a big one, because at the end of the day, we really want to create a stream of income to pay for care. And whether it's going to be insurance or not, the health is probably the biggest thing. And I find a lot of people who feel healthy at the time envision themselves always being that way, right? So sometimes we have to ask ourselves, well, if we live a long life, is it possible that we could eventually have an illness, eventually have an injury that would cause this to happen? So I think sometimes it's an emotional barrier to get over, to say, you know, this is a big enough risk that I do want to protect while I'm young enough to lock it in. Because I find the people who wait sometimes end up having that health condition happen, and then they're more likely to want it at that time. So I think, does that make sense, Steve?
Absolutely. And so just thinking that through, like, I'm feeling good. I'm at a young enough age. Let's just say, for argument's sake, the person's like in their early 30s. And so somebody approaches them to say, would you like long-term care insurance? It's like, well, that sounds like it's for way down the road and I'm feeling great, so I don't need it now. I'm good. And then fast forward, something happens 20 years later, and either they can't get the coverage or they can get it. But like many other things, it's better to do it young when you don't need it. It'll be a lot less expensive, I'm sure.
Yeah, that is definitely a consideration. And then how many years you're going to pay into it. So sometimes if you can find out what that sweet spot age is, right? Our average age to do it is 53, but I do find it's trending younger. And as long as you have that inflation protection built in, it can make sense over time to lock it in at those younger ages. It just depends. I find that the 30-something-year-olds are thinking, well, now I wonder if my parents have a plan, and they often end up wanting to look into the 50, 60-year-old parents first, and then they end up maybe being a caregiver at some point. And that's when they really want to say, I've seen what this looks like without a strategy. Let me try it my way with a strategy. And those people might be more likely to move forward sooner, if that makes sense, Steve.
Yeah. Hey, Terry, can I add to that a little bit?
Absolutely.
I think another barrier is sometimes the cost. People think that it's so expensive they don't even want to be bothered with it. But if, you know, as we're saying, you know, everything is a tailored approach, you'll be surprised at how, you know, affordable it can be if, you know, look at it from your budget, see what you can afford. So a lot of people kind of just throw it to the wayside because they think it's expensive, but the reality is not.
Yeah, that's a really, really good point, because the whole point of the insurance is to kind of have that smaller premium that you're paying over time to create that larger tax-free pool of money for care. And It is based on age, gender, and health, but I think a lot of people are like, well, long-term care itself is expensive, and they don't really know what the insurance costs, but maybe that's what holds them back, because they're afraid that will be also pricey, right? And it is meant to tailor into someone's budget, even if someone has help, you know, to not do the whole 65,000 of coverage a year, but say 30,000 or 40,000. I think that family's still going to be very grateful that they have some help, you know, to come to the house and help out the family if they're doing most of the caregiving.
I think those are great points, you know, and I've seen it play out firsthand, where is when I first got my job here at the university, and they roll out, here are the benefits available, and long-term care insurance was among them. And here I was in my early 30s, and long-term care seemed like way, way away. And then, you know, unfortunately, I had somebody that kind of walked it through to look at, well, here's what you'd pay now, which was a lot less than, say, now in my early 50s. And, you know, what that could cost in terms of long-term care if you didn't have the coverage and had to pay out of pocket, and it was astronomical. So it really, really made good sense when it was set up and explained as far as the cost-benefit analysis, that, you know, it may seem like a lot now, and it was a pretty reasonable premium at the time, but if something had happened and you had to pay out of pocket for all these care costs, you'd be far, far better off if you had gone with the insurance. So that was a significant motivator to our family deciding that we wanted that. Enough about me. I have a question here from an audience member who writes in, what is the oldest age that one can purchase coverage? Is 78 too late?
No, but so it goes from age 25 to 79 on the traditional side. So 79 is the oldest age, and I have worked with several 70-plus-year-olds, but then it just becomes a little more important to do that pre-screening, so we set proper expectations. On the hybrid side, that max age is 75. So 78 is not too old. You're still going to get some leverage for your dollar. But because you're closer to that need happening and you're going to pay for less years, the premium, of course, is going to look a little different than obviously, someone younger.
Thank you for that. We're starting to get a lot of questions coming in, and this is great. This is totally what we wanted. So here's one. I have had a long-term care policy since 2012. They have significantly increased premiums approved by Florida from, put my glasses on for this, from $5,100 per year to $7,800 per year. This includes a decrease in the overall coverage. The policy has 3 years of benefits at $464 per day, no longer inflation protected. I am 72 years old. Is it beneficial to keep this policy, assuming premiums will increase again, or should I freeze it?
So that brings up a whole topic of the history of premium rate increases, right? We've been in the business for 30 years now with long-term care. That's about how old the industry is. And back in the day, all the insurance companies didn't realize how many people would go on claim and how few people would lapse. So the policies were severely underpriced for actual claims experience. So, so that created a lot of companies to either go out of business or continue to have pretty significant rate hikes, right? We even had 2 of them over the last 30 years. And then on our second one, if the state, and it's always state approval that says, okay, we're going to support you in this. It's okay to ask for the rate increase, but we promise to never have a third one. So because of the strength of our company, the dividend eligibility being built in, like we have repriced the product, all of the industry has really from 7 years ago to be more in line of what's actually going on. I would say, first of all, I do commend you for putting it in 12 years ago. That's a really good benefit per day, which would cover most nursing home scenarios. And I would say what I see a lot of people do when they have this conundrum, like, do I want the coverage, but is it really worth the growing cost of it? Is this going to keep happening? I have seen people take the inflation protection off of there. If you think about the $65,000 a year on average to help with home health care being in today's dollars about $65,000 a year, $180 a day, you have more than double that, right? So you have a very strong daily benefit, but I don't know your budget, your finances. So it's something that maybe if you want to meet with Everson and myself, I could look at the policy and give you some recommendations of, if I were you, this is what I want to have in force now. I usually don't ever make recommendations when you have an older policy to replace it, but maybe to reduce it to a more peace of mind coverage, but also peace of mind for your budget, if that helps at all.
I have one more question I'll bring in. Maybe it's going to be on a later slide, but it seemed pretty important enough to bring in right now. So it says, please share some cost examples of this particular insurance. It's not helpful to keep costs in the abstract.
Yeah, so it's definitely custom to every person because of the age, gender, health scenario. But I could give you an example of a 55-year-old female getting that average home health care plan that would last 3 years is somewhere in the $200 a month range on the traditional side. And for the hybrid side, because she would pay it off in say 10 years, it's probably going to be 3 or 4 times that, but it's life insurance if she never needs it. And the payments are only 10 years or spread over a lifetime. So without knowing your particular customized situation, like age, gender, and health, that's an example of a 55-year-old healthy female. So hopefully that just gives an idea of, what some of the costs might look like. And Steve, I don't know if there's any more questions. I did want to talk a little bit about how the IRS treats some tax incentives with long-term care premiums as well. Because I can't see the questions. I'm sorry.
No, that's okay, and I'm happy to keep an eye on all of that. I got a couple of places I'm looking for it. That takes care of the questions for now, but let's go ahead and roll on, and I can bring in some more later as they come in.
Perfect. Okay. So I was going to say too that once you do have a strategy in place, it's very smart to revisit it on a year-to-year basis. Some plans even have like a consumer price index inflation offer that you might want to review on a yearly basis with someone like Everson to, should I take the inflation offer to grow my benefits? But also on the tax advising and accountant side, right? The IRS really is encouraging people, of course, to get their own long-term care plans. Why? To protect Medicaid dollars at the end of the day. So they actually allow certain things like using your health savings account, your HSA dollars, to use those pre-tax dollars, to pay for long-term care premiums, and it's still going to be a tax-free benefit. There's also the fact that business owners don't have any rules to how much health expenditures they need to have before they can deduct some of those. And in the state of New York, certain states have different credits or deductions. In the state of New York, they do allow people who make under $250,000 to have a 20% income tax credit. So there's all these nuances to owning long-term care that might be beneficial in addition to having the value and peace of mind of having the plan itself. Okay, so I just wanted to bring that to your awareness. And we only have a couple of slides left, and then we'll take more questions. But if you were to ask yourself why work with a company like New York Life, we've been in business since 1845. We have wonderful seasoned financial professionals like Everson who wear a lot of different hats, but I love that we also have educational consultants like myself to help them who talk about these topics all day long. We are Fortune 100. We have the highest strength ratings of any life insurance carrier. And the fact that we're a mutual company and not a stock company means that we can do things like pay a dividend. We're always trying to align our interests with our policy owners' interests who actually own us as a mutuality. We have multiple solutions available, like I mentioned, both on the traditional side and on the hybrid side. And just a note about the hybrid those are guaranteed premiums. The traditional, to the point of the rate increases, we're allowed to ask the state for rate increases. So that's two nuances of the products right there too. But it's really because of all these bullet points that AARP and actually AICPA, they chose New York Life after vetting what few carriers there really are in the space, to help their members with solutions. And we've been around for a while, and we paid more than $1 billion in long-term care benefits already. And just, seeing the agents who have helped these clients and how it helps the family. That's why I feel really good about myself working with New York Life. And if you're at all, wanting to know how to get started, if you wanted to look into this, it would all be about reaching out to Everson, having a conversation, asking those or answering those pre-screen questions, and then setting an appointment to find out what the best path might be for you and your family in an educated way. So with that, Steve, is it okay if I stop sharing after this slide? Or should I leave it up? Okay.
What we can do is, if you want, let's bring it back to that first slide with the contact information. So this way, if anybody wants to get hold of Everson, we have that up. We can continue to talk and take questions.
Perfect.
I'll just put this back up here on the screen. And one thing that I've been getting a couple of questions on, I just figured I'd wait until now, just it didn't really fit in with the others. And I think it's really a testament to the fact that the information that we're sharing today is very useful, is if the presentation is available for download, either the slide deck or to have the recording available, just as a continued resource. So sharing a lot of information here in a short amount of time, and it's nice to have that available to go back to refer to.
Yes. So actually, we do have a recorded version of this that is, all compliance approved that we could send out. It's just that Everson would need your name and your email address to get that to you.
Okay, so we'll leave this slide up on the screen for a little while. And if you would like this information, go ahead and shoot an email to Everson, and we get this taken care of. And then also we have the contacts, everybody on the program today, so we can figure out how to get that information back and forth. And Everson, I'm curious, in looking at the clients that you're working with, have you noticed any trends? Are people starting to buy this particular product at a younger age?
Yeah.
Or are you getting people right in the middle, or is it a lot of, oh my God, I didn't plan, and now I'm in a bind, and I'm a little bit older, and I need this like right now, and the cost is high? Or maybe it's a little bit of everything. Just give us a sense of where that client base is.
So what I'm starting to see is that it's again that little sweet spot between 50, 51, 52, but they're mostly clients that had to take care of their parents and had to go through that. So now I'm getting those clients that are saying, I really don't want to put my kids through the process that I went through. So they're looking into getting a plan for themselves. That way, don't have to be a burden to their kids. So it's around that sweet spot. I forgot what Terry called it. Is it the sandwich baby?
Sandwich generation, yes.
Yes.
I like
So
sandwich better, though.
pretty much all my clients, they have experience. They've seen what it takes to take care of their aging parents and what that cost was, and they kind of don't want have to burden their kids with that. Real quick, Terry, before I know we're getting close to the end, can you touch on that tax in Washington that's been implemented?
Yeah, it's
Just
good to understand why that happened.
Right.
So in Washington state, which, across the country, what happened was they put a bill into law that said, starting on this date, which was, I think it's now a year and a half behind us, but they started taking 0.58% of every W-2 worker who was 18 and older. And in exchange for that, they gave them a state-based long-term care plan for $36,500 worth of coverage, basically $100 a day for a year. And the way they did it, though, is like, well, we really shouldn't make people with long-term care insurance pay this tax. So we're going to we're going to give them an opt-out window. So they said, okay, everyone who has it in place by X date, basically will be able to opt out of the tax forever as long as they keep the long-term care insurance in place. So of course, everyone ran out in the state and tried to get New York Life policies, other policies, and we were the last one standing, but we ran out of capacity after 3 months out of those 6 months. And at the end of the day, they were doing it to protect their Medicaid dollars, figuring if we kind of force this issue or collect the money for these policies, then we're going to be less on the hook with those Medicaid dollars. So other states have been studying this, watching this. There's 9 other states that have been, looking into these particular bills. Like for one example, New York State put a bill up there. They brought it down. Now it's an election year, so nothing's happened this year. But, California has a task force committee also doing the same thing for the same reasons, looking at different plans they might put in place and what percentage of somebody's paycheck they're going to take in exchange for that. So I think it's just really good to bring awareness to the fact that baby boomers are on the rise, like extended healthcare costs are on the rise, and Medicaid isn't really going to be able to foot the bill. So what else are they going to do? That's why the other states are looking into doing what Washington did. But there's talk that they're saying, well, either you have the long-term care insurance or you don't, because even if we say, here's your opt-out window, you might not be able to get that policy anyway because of, the supply and demand of policies out there. So I hope that makes sense. It's a big topic, but you can read more about it. If you just search the Washington CARES Act, it'll come up and you can read through it.
Yeah, no, thanks for that. I think it's a very important topic to look at.
For sure.
Yeah, certainly very interesting. I think one of you said earlier, when one state picks up on doing something like this, it tends to catch on almost like wildfire, and the others do as well.
Right.
So we're seeing it in one place today. We could be seeing it in a bunch of places tomorrow. So it's always good to keep abreast of that. So you may remember a couple minutes ago that there was someone who had emailed with a question and wanted to get this out of the abstract with in terms of cost estimates. And Terry, you said without knowing the particulars, it was hard to answer. So he did write back. And so he's a 65-year-old male, no current medications or health issues. Kind of talk us through traditional and hybrid premium costs if you can.
Sure. So the way a lot of 65-year-old males, because that is a lot of our clientele will be that age. And if they've gone through the pre-screen and they're, they've told us what medications, conditions, and they say their preferred health status. There's like 3 different health ratings where preferred is the best rating, select standard, and then standard. But you start to pay 50% more or 100% more premium. And then there's like not being approved. So I'm going to go with like assuming that it sounds like you're a preferred health risk. So, you would look at traditional versus hybrid. So if you did the hybrid called Asset Flex, you could do a single pay reposition of assets into the plan all at once, or you can do a 5-year payment plan, be done when you're 70 years old, or do a 10-year payment to be done when you're 75. And those premiums, a lot of 65-year-olds are paying about $10,000 a year for 10 years. So call it $100,000 over 10 years. And that usually leverages into a policy that's going to start you out around $400,000 of long-term care coverage for a 6-year benefit period, with a 3% compound inflation factor built in, so that you'll be growing that $400,000 over time. $5,000 a month, that'll be growing over time. So that's an example of how a hybrid would work, with pretty general rough cost estimates, without doing anything like bringing up the software, on which I'm not supposed to do on a presentation like this. But so that if you wanted to solve the problem in a lower premium type of way than spending $10,000 a year, I would estimate that if you did that on a traditional platform like our Secure Care or our MyCare product, then that $10,000 very easily could come down to $2,000 or $3,000 a year annual premium. But it's going to be spread over your lifetime, not be all paid up guaranteed in 10 years. So I hope that helps. But Everson would be able to run the real numbers for you if you reach out to him. And it depends on if you're married too, because married partners or domestic partners, even, there's a 25% discount available on the traditional product. So a lot of couples do this planning together. So I was assuming that you were a single man there.
Thank you for that. One question I have, and it may sound a little bit off the wall, is, are there any conditions that would pretty much automatically disqualify someone from getting the coverage, or is it the kind of thing where pretty much anybody can get the coverage, just a matter of what tier you're going to wind up being assigned to?
No, that's a really good question. So the industry itself declines about 30% of applicants, and some of the reasons might be, one is very simple: you're off the BMI chart, right? So height and weight does count. Parkinson's disease is there's almost a near certain need that you're going to need long-term care. So that would be a knockout as well. If you've had multiple strokes in the past couple of years, right? Sometimes there's conditions like that where you can go years of stability, or even like be a breast cancer survivor and it's years gone by, then you'll be okay and possibly even preferred. So it just really depends on the kind of the nitty gritty of your health history, where we can go to the underwriters and say, can we quote this person at preferred health risk or one of the lower health risks, or are they even insurable? So it's very different case by case.
Thank you for that. It certainly sounds like if you're younger and healthy, take advantage of it at the time and don't wait and get the coverage, because it could get a little bit trickier later in life as certain things happen. I'm curious, as we have about 5 or 6 minutes left before we come up to the top of the hour and we start to wrap up, what other sorts of commonly asked questions do you receive by people who are beginning to shop for this coverage, or they get into the process and they find it to be a little bit kind of confusing to sort of navigate?
Yeah, I mean, I think it's not as cut and dry as life insurance, right? Because we don't know exactly how much benefits we're going to need. So I think educating people on how long these events usually last and how many dollars are usually spent is a starting point. But it's always just an example of, here's how this average size plan would work for you. And here's what the premium cost is based on your age, gender, and health, right? And does that even fit your budget? And if it does, then you apply, you go through the application process. And a lot of people want to know, well, how long does that take? It can take 4 to 6 weeks if we're pulling medical records for cause. There's no labs involved. And then the nice thing is when we come back and we make that offer, say it's that preferred health risk or something lower, then we can, tailor what you decided to apply for and make it if it's preferred, you can go to a larger policy, or you can tier it down and say, I just want to supplement my retirement plan. I just want $100 a day for 3 years and I'm good, because I feel like I'm going to have the care coordination and all the bells and whistles, but not have a large plan. And it's really easy on my budget. So it's very customizable. Like once you go through that process, see what the offer looks like, actual real numbers, and then dive deeper into the different riders and the bells and whistles that are available to you. So I would think high level first, is the strategy going to make sense for me to put something in place, lock it in? Should I put that application in to see if my health will qualify, and then make decisions based on real offers?
Yeah, as you said, a lot of things are very situation specific, and so it's helpful to get connected with somebody like Everson to run those numbers for real. And I think of something an agent told me, it was when I was setting up, actually, it was homeowners insurance, not long-term care insurance. That you never want to be insurance rich and cash poor. So it's trying to find that right balance between getting the coverage you think you're going to need, but not putting yourself in a bind and paying for it today or tomorrow. So lots of factors to weigh in. And so I just want to throw it out to both of you. Any sort of closing comments that you'd like to make before we start to say goodbye and do the close of today's webinar?
Yeah, Steve, thanks for having us for sure. You've been a great moderator. But, just one of those things, just making sure you go ahead and get a financial checkup. You want to go out there, make sure that everything is in place. You have a retirement plan in place. Strongly consider even putting a long-term care in that retirement plan to safeguard those dollars. But it is important, and even if you just want to, sit down and talk with me, just to see where you are and what your goals are, and see if there's any holes there that we could, fill, and making sure you're stable and into retirement.
And on my side, I just want to thank you for your time, everyone on the call, and that I'm mainly an educator, a resource for Everson and his clients. So, I'm here in the background to help, but I really appreciate everyone's attention today.
Thank
and
you,
I
Terry,
lied.
for
I have
doing
one
this.
more question that just came in. So let's go ahead and take it, since we have about 3 minutes. So certainly plenty of time to hit it. What are, if any, the implications of having submitted and received DNA tests? For me, it was pancreatic screening. All good, thank God, yes. But are these tests ever used against prospective policyholders?
That's interesting. So the only time we look at genetics for long-term care is like this one disease, which is apparently very, very, it passes down from generation to generation, called Huntington's. And so there will be a question about that. But that brings to mind something about cognitive. Remember, I said that cognitive decline, Alzheimer's, dementia is like an automatic claim for long-term care. One other piece of the underwriting I forgot to mention is that when you get to age 60, we start to do a memory screening as part of the underwriting process. But that being said, I get the question all the time, does that mean that if I have Alzheimer's in the family, that could make me non-insurable? And it's really usually a no. There is one question on the tele app, because that, if someone, I think it's under the age of 45, has cognitive, they do consider that, but they may or may not decline you for it. But that's the only question they ask about other things. But they would never test like you just went to check your DNA because you're curious about XYZ. That wouldn't be a medical record per se. So we wouldn't pull that.
Well, Everson, Terry, thank you so much. And certainly, Everson, I'm appreciative that you reached out to us, and I know you're very passionate about wanting to help people in the Binghamton Alumni Network, and I hope we were able to do that today. It's a tough topic to treat in 55 minutes and to be able to dive into all these specifics. So the ability to reach out to an agent and somebody in the know after a program like this is very important, to dive into those specifics. We can only set the table and do so much within terms of one program. So whether it's Everson, or if you have a relationship with somebody else that's in the industry that you feel comfortable working with, that's cool too. But the more information, the better. Certainly some very heady decisions to make when getting coverage like this, and a lot of factors to consider. But we hope you came out of this program more informed than you were at the start at noon Eastern. So Everson, Terry, thanks so much for joining us here today. Appreciate you sharing your knowledge with us.
You're welcome.
Thank you. Thank you, Steve, giving us the opportunity to do so.
And thanks to all of you for tuning into the webinar today. So just one more time, since we're a few weeks out from homecoming, I'll put in a plug. We would really love to see you here on campus starting Friday, September 27th to Sunday, September 29th. Homecoming will be a homecoming unlike any other, with the celebration of the Accelerate campaign. We'll have a Tier Talk speaker event, the Fall Festival, downtown block party, lots of gatherings, big and small. So no matter when you came here to Binghamton, and when you graduated, you're going to be almost certain to find something new on campus, something fun that you like to do, something that you remember from your time here that is still here and can make memories while reliving the old memories. So check us out. I'll pull up the website one more time, binghamton.edu/alumni. The homecoming link is right there on the homepage, and you can find your way to all sorts of other things that we have going on that will help to connect you to us here at Binghamton. And so we'll be back in a few weeks with a webinar looking at making career pivots. And then we have a webinar coming up in November. If you're an aspiring writer and want to know how to get your work into print, it's something that we had a lot of demand for, a topic like that. You'll certainly want to join us for that webinar. So we'll be active every month, providing good content for you. And we certainly appreciate you spending your time with us as you have today. So for Everson Davis and Terry Judge, I'm Steve Seebersod. Thank you so much for joining us, and we'll see you at the next webinar.